Welcome to our video presentation analyzing the financial status of Starbucks Corporation, the world's largest coffeehouse chain, headquartered close to home in Seattle, Washington. Our team will be highlighting the major points of financial analysis for Starbucks and its competitors. Michael Minarik will be presenting first, followed by Kaci Marshall, Svenja Kurth, and Braxton Tillman.
Okay, so this is the Porter's Five Forces analysis for Starbucks. Starbucks considers the competition in the industry to be really high. They compete with large fast food chains such as McDonald's and Dunkin' Donuts, or any fast food chain that sells coffee, but they also compete with local specialty shops, just local coffee shops. As such, the potential for new entrants is kind of mixed. For these low specialty shops, the barriers to entry are really low. And even though they're not taking a huge market share from Starbucks, they do cut into their profits. The power of suppliers varies, since most of their suppliers are suppliers of coffee beans, which they get on the commodities market, and those are subject to market fluctuations. The way that Starbucks mitigates those risks is by entering into fixed priced purchase contracts. So the power that suppliers have can be, range anywhere from medium to high. Customers don't have too much power, so Starbucks doesn't worry about that, but they do pay attention to customer preferences and trends. And the threat of substitutes, from Starbucks' perspective, they consider it to be very high. So inventory for Starbucks consists mainly of unroasted coffee beans, but they do also sell bottled coffee, bottled tea, and they have various brands that they carry as well. So those are also considered inventory. But you can see that the relative size of inventory as a percentage of total assets has declined over the last couple of years. And Starbucks mostly attributes that to the pandemic in 2020. Obviously, coffee beans are perishable, and as plants and stores shut down, they had to basically just throw away a lot of their inventory. So you see this decline in inventory turnover and an increase in days inventory outstanding as well. And that affected their cash conversion cycle significantly, increasing it by over 10 days. But surprisingly, although their sales did dip a little bit, they were able to maintain a comparable gross margin percentage to 2019 and 2018. Tangible assets for Starbucks mainly consists of coffee makers and espresso machines. And we can see from 2019 to 2020, there was a dip in the total tangible assets. That's mostly due to restructuring activities that Starbucks has taken. They're getting rid of a lot of their storefronts, and as a result, a lot of that equipment. Also worth noting is the large spike in total assets from 2019 to 2020. That is mostly due to the adoption of the new accounting standard for operating leases. That, coupled with the decrease in net sales, again, due to COVID-19, resulted in an overall decline in the PP&E turnover from 4.29 to 3.71. In 2020, Starbucks implemented the new accounting standard for operating leases, in which those leases are capitalized and recognized on the balance sheet. And they did so on a prospective basis, but had they done it on a retroactive basis, we would have seen dramatic increases in both total assets and total liabilities. As we can see in this first table, total assets would have been increased by an average of about 45%, and total liabilities would have increased by an average of about 60% across those 4 years, that 4-year span. We also would have seen a very large increase in net operating assets, in return on net operating assets would have been in the mid to high 20s. The return on equity, I don't think we would have seen any changes, as the new leasing standard didn't affect equity and we didn't make any adjustments to the income statement. But we did see both dramatic increases and decreases in the non-operating return. So here we have the valuation allowance for the deferred tax assets that Starbucks has. And you can see in the ending balance that over the past 3 years that the valuation allowance has been declining. Typically, we would, with that, we would expect to see a decline in deferred tax assets as they're being written off, or as we have net operating losses being carried forward. But that's not the case here. Starbucks does say that they have written off deferred tax assets in their foreign subsidiaries, but they attribute most of the increase in deferred tax asset to the 2020 implementation of the new accounting standard for operating leases.
We look at market capitalization for both Starbucks and McDonald's, its major competitor. Records from September 28, 2020 have Starbucks' market value of outstanding shares at about $100,679 million. Starbucks reported book value in 2020 was negative $7,799 million. So the market to book ratio was calculated at about negative 13. Comparatively, we look at McDonald's records from December 30th, 2020, where market value of outstanding shares was about $157,051 million. Reported book value in 2020 was about negative $7,842 million. So the market to book ratio was calculated at about negative 20.3. This low of a market to book ratio signifies potentially undervalued stocks, in this case for both Starbucks and McDonald's. For the disaggregation data analysis, we analyzed Starbucks, McDonald's, and Dunkin' Donuts. We face a slight limitation in this section. 2019 is the most recent data we could access for Dunkin' Donuts, so the comparison isn't as ideal as we would hope, but we still believe it provides useful information and relevant comparisons. Starbucks has improved how assets are financed since 2019, increasing return on equity by 86%. McDonald's ratio also has increased, but the increase was only by about 29%. And Dunkin' actually experienced a 5% decrease from 2018 to 2019. Starbucks had a remarkable profitability bounce back from 2019, but ROE throughout the years has varied drastically, so it doesn't necessarily mean that it will be sustained. Return on net operating assets is an aggregate measure of profitability and productivity. Starbucks RNOA for 2019 and 2020 was 41% and 12.2%. McDonald's RNOA for 2019 and 2020 was 23.63 and 18.74. Starbucks had the greater profitability percentage in 2019, but had a rather drastic decline in 2020, whereas McDonald's experienced a decline, but not nearly as drastic. Dunkin' Donuts RNOA increased a slight 5% from 2018 to 2019. Productivity data remains fairly constant for all years amongst all three companies. Profitability seems to be the reason for Starbucks' decline, as net operating profit margin has decreased by 49% since 2019. This next slide kind of puts some of the data points we've been discussing into a visualization. The trend line represents what is expected across the industry. McDonald's is near the tail end of the trend line, having a relatively higher profit margin, but a lower level of efficiency compared to the rest of the industry. Although McDonald's is considered a competitor of Starbucks, there are definitely some differences in product offerings, which could explain the difference in profit margins. Dunkin' Donuts and Starbucks have the most similar product selection, so you'll see that their profit margins are very similar. Now looking at revenue recognition for Starbucks, we've experienced a reduction in revenue of about 11.8% from 2019 to 2020. Revenue for Starbucks includes company-operated stores, licensed stores, and other revenues. About 81% of total revenue can be attributed to operated stores, And from 2019 to 2020, Starbucks experienced a decline of 11%. Licensed stores account for about 10% of total revenue, and this also declined by about 19%. Other revenue is the remaining 9% of Starbucks revenue, and it also declined by about 3%. Deferred revenue accounts for about 17.7% of total liabilities in 2020 and 26.5% of total liabilities in 2019. The reason deferred revenue accounted for a much greater percentage in 2019 is because total liabilities grew by 46% from 2019 to 2020, but the deferred revenue balance is only reduced by about 2%. Additionally, this large increase in liabilities might explain the drastic drop in operating income that Starbucks has experienced. Following a global pandemic, which severely affected the food service industry, it is not surprising to see a reduction in revenue and an increase in liabilities. McDonald's, the major competitor of Starbucks, experienced a similar decline in revenue, although not as drastic at about 8.87%. The entire industry was forced to adjust to changes that came with COVID-19, including government shutdowns, staff shortages, increased pricing due to the shortcomings of the supply chain, and much more. Accounts receivable for Starbucks are mostly comprised of product and equipment sales and license royalties. Starbucks' reliance on receivables has been fairly consistent over the last 3 years, sitting around 3% to 5%. For operating expenses, as I have mentioned before, liabilities have increased drastically. Reviewing common size income statements, operating expenses were sitting at about 39% of total revenues in 2018 and 2019, but this raised to about 46% in 2020. This increased total operating expenses to 95% of revenues, which was a 10% increase from previous years.
Now let's talk about the balance sheet analysis. Starbucks' largest assets in 2020 include operating leases, property, plant and equipment, and cash. The increase in assets is mainly due to the new lease standard, ASC 842, which Starbucks adopted to in 2020. The largest liabilities on the 2020 financial statement are long-term debt, current liabilities, operating leases, and deferred revenue. The increase is mainly due to the new lease standard. The debt-to-equity ratio for Starbucks decreased from 2019 to 2020, indicating that management is no longer using debt for its operating activities. The debt-to-equity ratio in 2020 was 1.27, and in 2019, it was 1.32. Prior years, the ratio was increasing, which indicated that management was using more debt to run its operational activities. You can also see the other ratios we did calculate. The income statement analysis. The income statement for Starbucks shows that the major expenses for Starbucks are product and distribution costs. The financial report does not show any discontinued items. Considering income for the past years, Starbucks is less profitable than it has been in the past. The operating cash flow in the amount of cash inflows and outflows from operating activities, excluding discontinued operations. Operating cash flow includes transaction adjustments and changes in value not defined as investing or financing activities. Starbucks inflows include depreciation and amortization, distribution received from equity method investors, stock-based compensation, non-cash lease costs, loss on retirement and impairment of assets, other operating assets, and liabilities are prepaid expenses and deferred revenue. The outflows include deferred income taxes and income earned from equity method investees. Accounts receivable, inventory, income tax payable, operating lease liabilities, and accounts payables. The net cash provided by operating activities decreased in 2019 by 68%. The decrease is a result of the decrease in net earnings, including non-controlling interest and the adoption to the new lease standard. The net income of Starbucks was $928 million compared to its 2019 net income. The decrease is mainly due to the temporary closing of stores in the US and all over the world due to the Corona-19 pandemic. The cash provided by financing activities are 1,712 million compared to cash used in financing activities in 2019. It was way higher by 10,075 million. The decrease was primarily due to higher repurchase prices of Starbucks stock and higher purchases from issuing long-term debt. We also did calculate other debt ratios for Starbucks and compared them to McDonald's, which you can see in the table. And we can see that Starbucks is doing not as good as McDonald's. Now, if we look at the current ratio for Starbucks is 1.06. That would mean that Starbucks could pay back his obligations. However, it's not desirable. The whole industry was in decline from 2018, as you can see in the graph to the side. And you can see that it was not just Starbucks, but McDonald's and the whole industry declining and is now recovering. The quick ratio above 1 is considered favorable, and Starbucks is below 1 at a 0.75. That means that it has not enough current assets to cover the payment that are due on their current liabilities. However, we can also see that the whole industry is not above 1, so it might also be an industry-specific issue that they won't be above 1.
For this part of the presentation, we'll be speaking on contributed capital, beginning with financial leverage. So for the past couple of years, Starbucks has taken on what we call a equity deficit. What this means is the total value of their liabilities taken on exceeds the total value of the assets that they own, meaning that their stockholders' equity is negative as well as their financial leverage. We believe they're taking on this approach in an attempt to obtain higher returns in the short term. And as far as we can tell, that's worked very well for Starbucks. They've continued to do well as a company, but we've also seen that historically that approach has not been very sustainable in the long term. So it'll be interesting to see how Starbucks operates in the future, if they continue to take on this very risky approach to equity or if they move towards a more conservative approach. In the top right corner, we've got listed common stock. And what we've done with this chart is essentially list the shares outstanding for both 2020 and 2019, as well as their values as listed in the balance sheet according to their par value of 0.001 cents. On top of issuing these shares of common stock, Starbucks has also authorized 7.5 million shares of preferred stock in each of the past 2 years. Moving forward down to the treasury stock down at the bottom, as you can see, in 2019, Starbucks was able to repurchase around 140 million shares of common stock for about $72 per share. And in 2020, that number dwindled down to about 20 million shares of common stock for about $84 per share. The reason for the discrepancy in the amount of shares repurchased is because in March of 2020, Starbucks actually chose to suspend their shares repurchase program. Something interesting that I noticed with Starbucks is when they immediately after they repurchase treasury stock, they retire the stock and they deduct the par value of the treasury stock repurchased from the common value, from the value of the common stock in their balance sheet, and the excess value of the treasury stock repurchase is then deducted from additional paid-in capital as well as retained earnings. So there's no treasury stock account in their balance sheet. And the reason we found that the reason they do this is an attempt to reduce the chances of any dilution in their earnings per share. Stock-based compensation. In this case, Starbucks primarily utilizes time-vested options. These options become exercisable in 4 equal installments, beginning a year from their grant date, and they typically expire in 10 years. So what we've done with this chart is we've essentially showcased the stock options outstanding, the exercised options, the expired options, and the options vested or expected to vest from 2019 and 2020. Continuing on to our earned capital portion of the presentation, starting with return on equity. Something that really jumps off the page is the huge discrepancy from 2018 to 2019. It's pretty much a complete 180 from 137% to negative 142%. We attribute this to Starbucks making the shift to taking an equity deficit in the year 2019, as we mentioned before. Moving along, we have our accumulated other comprehensive income for the year 2020. We've listed the 4 contributory accounts and available for sale securities, cash flow hedges, net investment hedges, and foreign currency translations. These amounts totaled beginning of the year to a loss of 500 million, around 503 million. Starbucks is actually able to have a gain of OCI during the year of around 140 million, resulting in them ending the year with a loss of 364 million. Lastly, in the earned capital portion of our presentation, we have our dividends payout and yield. As you can see, their dividend yield was already less than 1% in 2018. It's only gotten progressively worse. This is a bad sign for investors. They're typically looking for something a lot higher, definitely not less than 1%. And so we'll have to see if that trend continues.